Welcome to Peachtree Point of View. Recently, our team came together to share insights, experiences, and updates that we believe you'll find valuable. Let's jump into the conversation.
Welcome to our National Opportunity Zones Digital Summit. Welcome to the 2.0. My name is Alana Faust here at BizNow, and I'm coming to you live from Washington, D.C. Today's webinar, we will be discussing tax benefits, capital flow, opportunity zone partnerships, and overall the long-term impact that it'll have on the commercial real estate market. Our sponsors for today, we want to say thank you to Peachtree Group, Eisner Amper, and Seyfarth Shaw. Today, our panelists will be Michael Torhan, partner at Eisner Advisory Group, Matt Peurach, partner at Seyfarth Shaw, and Greg Friedman, CEO and Managing Principal of Peachtree Group. So I'll turn it over to Greg for him to kick us off.
Thank you, Alana. I'm Greg Friedman, CEO of Peachtree Group. We're going to talk about opportunity zones and the new tax law, as well as talking about opportunity zones as it relates to the original, 1.0 version. Started Peachtree back in 2007. We're a private equity firm that specializes in commercial real estate. We invest a lot through credit as well as equity as it relates to commercial real estate and hotels. As it relates to opportunity zones directly, we've executed over a dozen development projects in different opportunity zones, primarily for hotel properties. It's been a program that we utilize Opportunity Zones 1.0, and we're excited about the new program 2.0 that we'll talk more about here shortly. With that said, I'll turn it over to Matt.
Yeah, sure. Thanks, Greg. Hi, everybody. I'm Matt Peurach. I am a partner in the tax and corporate group with Seyfarth Shaw. I'm based in Atlanta, and I guess my practice is primarily focused on tax structuring and closing transactions that involve equity coming into real estate. And so when OZ 1.0 became a thing back in 2018, for a couple of years, really took over my practice. So I've worked with a lot of different opportunity zone fund sponsors, investors, operators to try to put the tax structures together to make their deals come to life and realize all the tax benefits.
Hi, everybody. Michael Torhan. I'm a tax partner at Eisner Advisory Group, specifically in the real estate practice. We have a national real estate practice specializing in everything from, closely held joint ventures up to very large real estate institutional funds. We have a particular specialty in qualified opportunity zones. I personally have done a lot of work starting back in 2018, 2019 when these first came out, all the way through the present. I think when they first started out 7 years ago, it was a little quiet in the beginning, but then once the zones were designated and the regulations were issued, everybody, including Eisner, we got a lot more involved with the structuring, with the consulting. We also do the tax compliance, the tax reporting. And I'm looking forward to speaking with Greg and Matt here and all of you about what's happening these days.
Matt, can you walk us through just, the core tax benefits of opportunity zones? I'm assuming most people understand it, but just maybe to sort of level set the discussion for those that aren't as familiar with opportunity zones, if you could walk us through the tax benefits and how it works. And then let's talk about OZs 2.0 and what's new there next.
Yeah, sure. So just, I guess, to set the stage before we get into all the nitty gritty as to how the law has changed from 1.0 to 2.0, I guess the core tax benefits for doing an opportunity zone investment are really three things. You're talking about deferral, a discount, and elimination. And so the easiest way to, in my mind, the easiest way to describe how those three tax benefits work is just through a simple example. So let's say that I'm sitting on stock that I purchased for $1 million. It's appreciated to value for $2 million. And so I sell it. And so I have $1 million capital gain on that sale of stock. I have two options at that point. I can either pay my tax, it was a nice investment, or I could pursue an opportunity zone investment to try to get some tax mitigation relief on that $1 million capital gain I have. So what I could do if I wanted to do an opportunity zone investment is within 180 days from the date that I realized that $1 million capital gain in my example, I could invest as much or as little of the $1 million into a vehicle that is set up to be a qualified opportunity fund. And let's, for sake of illustration, just assume that I elect to invest the full $1 million capital gain into the OZ fund. So under present law, if I were to do that, the first tax benefit I get is deferral. So if I invested that $1 million gain into an OZ fund today, I would defer paying the tax liability on it until the end of next year. So under OZ 1.0, the deferral period stops at December 31st, 2026, which time I do need to pay that tax liability. So that's tax benefit one, is just deferral. Tax benefit two that I said was discount, which under OZ 1.0 is currently not available. But if I change the facts a little bit, and let's say that I invested that capital gain into an OZ fund back in 2021, by the time the deferral period stopped at the end of 2026, I will have held that investment for at least 5 years, which would mean that I get a 10% discount on the tax liability that I need to pay when the deferral period stops. So that's tax benefit two. Tax benefit three is elimination of new gain with respect to my investment in the OZ fund. And so under that tax benefit, if I hold my investment in the OZ fund for 10 years, when the OZ fund sells its underlying asset that hopefully has appreciated during that 10-year period, I do not pay any tax on the new gain that gets allocated to me from that OZ fund. So those are the three core tax benefits by virtue of doing an opportunity zone investment.
Yeah, and Matt, just to jump in there really quick, we always like to, because we're dealing with the federal aspects of it and also the state aspects of it. The states don't all conform to the QOZ treatment, right? So I always like to kind of point that out. It's a great federal benefit, that 10-year step up, which is really the biggest benefit from what we've seen. The deferral is great. The 10% and the 50% haircuts are great. It's really that 10-year step up. It's one of the biggest benefits. All the states designated zones, right, back in 2018, during the initial time frame, not all of them conform to the benefits. These benefits may not apply in the states some of the listeners may be kind of in. So that's something to keep in mind. There's another benefit. It's kind of it's not publicized as one of the big benefits, but something I always like to throw out there. Any depreciation you take during those 10 years in your example, that depreciation is not recaptured, right, under the guidance that's out there as of today. You get to take depreciation just like any other business or any other real estate asset you might own. Generally, that depreciation is recaptured when you sell it, right? Because your basis has gone down. Under the QZ program, your basis steps up to fair value, right? So that even that recapture steps up to fair value. So that's kind of a nice add-on benefit.
Yeah, that's a good point, Michael. I mean, especially with you've got a pretty publicized mayoral election going on in New York, where New York is one of the states that do not conform with the federal tax code for this purpose. And so, same with California. So there are some state level concerns to always keep in mind when you're doing an opportunity zone investment.
You mentioned 2021, if you invested, you get the 10% step up in basis. And I got to assume a lot of people that are going to listen to this webinar have already invested in opportunity zones in the past. And the challenges are, if you invested pre-2022, values on average across commercial real estate are down, about 20% on average, right? So, everyone's dealing with this higher for longer interest rate environment. And obviously the valuation as it relates to opportunity zones 1.0 is coming at the end of 2026, right? I'm assuming at the end of 2026, you're going to value your investment and you're going to pay tax based on the lesser of that. If you invested in 2021, for instance, you'd get that 10% benefit. So you'd pay effectively a tax on the 90% of the gain versus 100% of the original gain. Or if the value had dropped, theoretically, just because, values have come down, you would pay tax based on the new value, correct? The lesser of.
That is correct. So the way that deferral and discount aspect of the tax benefits work is that when the deferral period is up, you are paying tax on the lesser of the amount that you put into the OZ fund or the fair market value of your interest on December 31st, 2026. And so that, that's one of the big hot topics right now is, and some people refer to this as the J curve. Depending on the underlying investment that you made through the OZ fund, as Greg pointed out, commercial real estate has been rather volatile the last few years. It's possible that the underlying assets, number one, in the OZ fund are worth less than they were when you invested. And on top of that, when you're talking about holding a partnership interest into an OZ fund, it depends on what the OZ fund is and how much of an ownership stake you have in it. But if you're talking about, a $500 million fund and you put in $1 million, there are certain discounts that can be attributed to that partnership interest, like lack of marketability and minority interest discounts. So, I think that as we approach the end of 2026, given that we're already at the end of 2025, that's something that's really important to start thinking about if you're an OZ fund sponsor and or investor. Is the current fair market value of my interests worth less than the amount I actually put into the OZ fund? Because ultimately that's what you're paying tax on when the deferral period stops.
Michael, has this been a hot topic from your perspective with investors that invested in, Opportunity Zone 1.0 as we're just getting closer to 2026?
Yeah, absolutely. I think with the QZ program in general, we've all been kind of learning and kind of engaging with the different issues throughout the last 7 years. Like 7 years ago, it was all about, how do you form a QOF? Like, what's the right structure? Do you do a 2-tier or 1-tier structure? We all really wrapped our arms around that concept. Over the last 4 years, 5 years, everybody's been all about, the working capital plans, the 31 months, the 62 months. What do you need to do to qualify, right, to operate? Now, as we get close to the 2026 kind of date, everybody's really focused on, well, what's that deferred tax going to be, right? What is that gain that's been deferred? What's the actual tax hit going to be next year, right? Because that, and we'll talk about QLZ 2.0. That was one of the things that was not changed or updated, right? That December 31, 26 date is still the date any deferred gains are going to be taxable. And so now everybody's focused on, well, the statute and the regulations, they do say, like you and Matt have said, it's the lesser of, right? What's your deferred gain, right? Subject to any adjustments? Or what would the investor realize on a fully taxable transaction, right? So a lot of QOFs are structured as partnerships. The actual guidance says it's, what would the investor realize on a fully taxable sale of that qualifying investment, right? Which is the partnership interest, usually, right? QOF investors own partnership interests, from a tax standpoint. And like Matt was saying, you got to value the underlying dirt, right? As we say, the actual real estate, has that gone up in value? Has that gone down in value? And then you have to value the actual partnership interest, right? The guidance says it's the fair market value, right, on a taxable transaction. Well, what's fair market value, right? Throughout the guidance, it's what a willing buyer and willing seller would exchange property for, right? That's fair value. It's a valuation question. And like Matt was saying, we have a valuation team here that, we have teams that value the real estate. We have teams that value the partnership interest. I just got off a call yesterday with a new prospect that is looking at this exact issue for some very large funds. Again, what is the value that these investors are going to use on December 31, 26?
And that was one of the questions in the chat box. Michael, you sort of covered this, but you're going to need some type of support at the end of 2026 to say that the value of the asset is whatever the number is. Do you need a physical appraisal, or just do you need to hire Eisner to provide that valuation and provide a letter of some support of it? Or how are you going to come up with that value to be supported by the IRS?
Yeah, fair market value, right, throughout the tax code and throughout case law is generally, again, what do a buyer and seller, what would they be willing to exchange for? Obviously, if the asset's still being held, you don't have an actual, purchase and sell agreement or some kind of live data, you would want to get some kind of appraisal, some valuation report, really to support that number, to support the tax reporting position.
If someone used Eisner, technically someone could hire you to help with that exercise, to provide that valuation support. And we've all learned through other conservation easements and other things like that can always become a discussion at a later date, but you need some support in order to manage, especially if you're taking discounts and so forth.
I think Greg, just to hit on that point, it's not that the tax code requires an MAI appraisal to be done. It's more an audit mitigation strategy, right? Is if you're going to be taking a position that the tax liability you're paying at the end of 2026 is less than what you put in, that's potentially an audit issue. And if you are audited, you're going to want some very credible support to justify the fair market value that you're claiming that you're paying the tax based on.
And one person asked, if an investor has an inclusion event, exited the OZ investment in 2024 after a 3-year hold, does the lesser of construct map discuss apply as well? So you're going to pay basically on the new gain, right? You're going to pay tax on the original gain if you exited before, if you sold the investment in 2024.
Well, it depends on what you sold it for. So
Right.
if you exited the investment for less than what you put in, that's what you're paying tax on. Yeah,
Yep.
but if you made new gain on that exit, then yeah, you're paying tax on the original deferred gain that you put in, plus potentially you're paying tax on the new gain that you realize from that exit. However, with respect to both of those gains, there may have been an opportunity to reinvest that back into the same or a different opportunity zone.
Yeah. And I'm assuming y'all both would agree the easiest way to pay no tax is to have a complete loss.
Probably not
I guess,
advisable to go for that strategy, but
Right.
yes, if that's like your only concern is paying tax, then
Right. And that's hopefully what, at least at Peachtree, we don't target that. We target actually to produce. We want to have, positive outcomes, very positive outcomes. What's different from y'all's perspective from Opportunity Zone 1.0?
yeah, sure. I can start on this. So number one, as I think Michael was pointing out, under the original law, it was kind of a fixed program that ran through the end of 2026. And so perhaps the biggest feature of OZ 2.0 is that now the law is permanent. So what that means is that once we're done with OZ 1.0 at the end of 2026, for any new investments that get made into Opportunity Zone funds in 2027 and thereafter, there is now fixed rolling 5-year deferral periods, as opposed to pegging the deferral period to a hard specific date. So one of the critiques of OZ 1.0, for example, is, look, if you invested gain in 2018 or 2019 into an OZ fund, you're getting a deferral period all the way through the end of 2026, and you're getting those discounts that we've talked about on the tax liability when the deferral period ends. But the closer you got to December 31st, 2026, that really marginalized that feature of the OZ tax benefit there, because you're getting a much lesser deferral period. Under OZ 2.0, like I said, you've got a fixed 5-year rolling deferral period. So it kind of doesn't matter from that perspective. When you're putting your gains into the OZ fund, you get to defer it for 5 years. And assuming you still hold that investment after that 5-year period from when you put your money into the OZ fund, you're getting that 10% discount on the tax liability that then comes due. So that's something that was really exciting, is just the overall permanency of the program. So I think another interesting feature of OZ 2.0 is that we got what are referred to as qualified rural opportunity funds. And so basically that's the same thing as a qualified opportunity fund, except it's one that's specially designated to invest in rural opportunity zones. And so we won't know exactly what those rural opportunity zones are until the new map comes out in July of next year. But if you were to do a project in a rural opportunity zone, then the tax benefits are supercharged. Where, as we said before, when the deferral period ends, if you held it for 5 years, you're getting a 10% discount. If you invest in a rural opportunity fund, you're getting a 30% discount. Plus some of the other, which I won't get into the weeds on, some of the like the substantial improvement test, some of the other OZ rules to make the underlying asset qualified have been relaxed with respect to rural opportunity funds. So I think that that'll be something that's really interesting. So like Greg, I think about for your investments, if you're talking about like select service hotels or things like that, it's possible that some of those could be in rural opportunity zones. So that'll be interesting when the new maps come out.
One question on the rural side. No one knows yet what will really qualify. You have different programs out there today that you have these rural designations. If you look at USDA lending, or you look at getting loans through the USDA for commercial real estate projects and hotel projects, you look at EB5, do you expect it's going to follow the same type of map, or you think it's going to be different? Or
all we know at this point is, in order for it to possibly be a rural opportunity zone, is that number one, the area has to have less than a 50,000 population. So that would be one. And then also it cannot be an urbanized area, as they refer to it, that's next to a tract that has a population of greater than 50,000. So I don't totally, it's easy to understand the population threshold there. I don't necessarily know what they mean about an urbanized area. So presumably there will be some forthcoming guidance and regulations to hit on that.
There was, just to jump in on that, there was some release from the IRS just like a week or two ago on some like initial set of current rural areas, right? Because on the QOZ 1.0 kind of zones, the IRS did release a notice kind of listing out which out of those would have been considered rural. But to Matt's point, I think a key item that everybody that's kind of invested or looking to invest in these zones is going to be, what are these zones going to be in the future, right? I think like Matt was saying, the program has been made permanent, right? On the QZ 1.0, the last date really was going to be December 31, 26. Those old zones do continue to 2028. Going forward, every 10 years, we're actually going to have new zones being designated, right? That's one of the new kind of changes from a designation perspective. It's permanent, but Congress really wanted these zones to be flexible and kind of dynamic and not kind of fixed in perpetuity. So they created this concept of every 10 years, the governor's offices are going to have to designate new zones. What can be designated is a little bit more narrower than under QOZ 1.0, right? Some of the income thresholds are lower, but effectively the governor's offices are going to have to go and identify what zones are eligible for designation, based on the parameters, and then they're going to have to select which zones are actually designated. So that effect, number one is, what zones are going to be rural. Like Matt is saying, everybody's going to pay attention to what are the rural areas, because they do get the better benefits. Number two, it creates a good question, right? If you're kind of eyeing a project now that you're thinking about in the next 5 years, well, you want that zone to be designated, right? So not every eligible zone is going to be designated. Right. Again, the governor's office is going to designate certain zones. So if you have projects out there that you're thinking about, and number one, they're a zone today, right? That doesn't mean they're going to be guaranteed a zone in the future. Or if they're not a zone, but they're eligible, you're going to want to potentially start reaching out to the governor's offices and kind of put something in front of the governor to show them, look, this is, I have a good idea. There's a good project that we can kind of, put down here. Can you designate this as a zone? Right? Everybody wants to be proactive because you don't want to run into a situation where you got this great project idea, but in 2 years you find out it's no longer a good zone or it wasn't designated a zone.
So just thinking about activity, if you're sitting on a site today that you're thinking about developing a new hotel, multifamily project, or you're looking at doing a substantial rehab to a property that sits in one of these zones that we know today is an opportunity zone, are you better off pushing forward, in your opinion, today? Or are you better off waiting for Opportunity Zone 2.0? Or what's your opinion? And I'll really open up to both of y'all. Or do you have an opinion as it relates to that?
I think, just to start off, I think it depends on a number of factors. I think number one is, what is your development timeline? What does your fundraising look like? I think a lot of people have been saying the next year and a half might be kind of a dead zone for fundraising, because one of the changes, like Matt was saying, if you invested in the past, you had a deferral through December 31, 26, you maybe got a 10 or 15% basis step up. Starting in 27 on the QZ 2.0, it's a rolling 5-year deferral. So no matter when you invest, you're getting a 5-year deferral on your capital gain. And you'll be eligible for that 10%, discount potentially. Well, if you have an investor that can invest with you in 26 or 27, they may want to wait till 27, right, to qualify under QZ 2.0. So that's going to be one of the considerations, is when can you actually fundraise? When can you get the project off the ground, right, and kind of developed? There is some uncertainty there as to, if it's a zone today, but in 2 years it's not a zone, and you didn't finish construction by that point, is it still going to qualify or not? There are some kind of uncertainties still out there that hopefully we'll get some guidance on in the next year or two, but it really depends, Greg. Another point is, if you've owned the property already for a while, you may not be able to benefit. Right. And this happened in QZ 1.0 also. Owners that already have property, right, in their hands, one of the requirements is you have to buy property, right, from an unrelated party. But there's different structures to still be able to benefit, directly or indirectly, right? There's structures where you could lease the property into a QZ business. You could contribute it into some kind of joint venture or QZ business and maybe not get QZ benefits, but get kind of fundraising benefits, right? You kind of attract investors. From my perspective, it's really, it's something you have to analyze. And we're doing exactly that with multiple clients now, kind of analyzing, do you just sell the property at a premium, right? Because it's in a QOZ and hopefully you could attract a better price. So it's a multifaceted kind of analysis, Greg.
Right. You have a site, say, in downtown San Antonio, because most of downtown San Antonio, the Riverwalk, is an opportunity zone, and we're developing a Marriott Residence Inn. Fortunately, that project's going to be open before 2026. So I do have two questions. I'll use that as an example. If it was just land, we hadn't started construction. The first question is, if the project wasn't going to open till 2027, do you have to be placed in service to still qualify under the Opportunity Zone 1.0 in 2026, or does that matter? Because that doesn't matter to be under.
So basically, Greg, what you're asking is if you have property right now that loses its OZ designation when the next round of maps come out, is that still a qualified Opportunity Zone project?
Exactly. That was going to be the, yeah.
That, and Michael alluded to this a little bit. There's still some uncertainty on the answer to that. Common sense would tell me that if you've started a project in an Opportunity Zone under the original Opportunity Zone maps, that you should be grandfathered in for doing that. But, we've seen other areas in tax law where common sense isn't necessarily followed. So that's one of those areas where we are waiting some forthcoming guidance on. And who knows what that guidance could say. I mean, maybe if it's, hey, we just have owned the dirt, but we haven't done anything with it yet. Maybe that's different than, hey, we're halfway through construction on a project in what was an Opportunity Zone that lost its designation when the new round of maps came out. So who knows what it's going to be, but that's just an area where we need some more clarity.
Yeah, and the old zones do continue through 2028. So Greg, to your point, the bigger issue would probably be if you didn't open the project or didn't do anything until 2029, potentially. Because there's only one very small example in the current guidance as to what happens in this type of situation. And the example doesn't really give us much, I think, guidance as to that question, because it really focuses on the QOF investor. The project was already in service for like 6 to 7 years. And the guidance just says, just because it's no longer a zone doesn't mean that investor won't get the benefits, right? It's almost like a negative comfort in a way. But yeah, to Matt's point, I'd assume that there'll be more guidance on this at some point from Treasury, and hopefully it'll be taxpayer friendly. And a lot of the guidance to date has been taxpayer friendly, I would say.
Someone asked, a question about investor activity, or are investors gonna, is going to invest today, or they're gonna, is there gonna just be that lack of activity? I think, Michael, you sort of hit on it. Personally, just from my perspective, I've definitely have seen, less, velocity of people wanting to invest into Opportunity Zones. I'm still seeing a lot of interest in OZs, but, just given some of the uncertainty, we've seen less capital flowing than what we saw in our first two, multi-asset op zone funds that we did several years ago. So it's definitely hit a low, but I don't know if y'all have, if you're seeing that lull as well.
Well, Greg, what I can say, I guess, from what I'm seeing in my practice is there's certainly a lot of talk about this dead fundraising period from now till when OZ 2.0 takes effect. But I think that there's a couple of things that are really important in that decision-making process. Number one, so if I'm a taxpayer that realized a capital gain and I'm interested in pursuing a tax mitigation strategy for that, and I want to do an Opportunity Zone investment, number one, I only have one 180-day period to put my gain into an OZ fund. So if I unload a bunch of stock right now, that 180-day period comes up before OZ 2.0 even goes into effect. So number one, there may not be a whole lot of flexibility to just wait it out until 2027. So that's one point I would make. And then another point I would make is, as Michael said earlier, one of the changes in OZ 2.0 is they tightened up the poverty thresholds for areas that can even be designated Opportunity Zones. So the poverty thresholds have gotten a little tighter there. So it needs to be more of a depressed area than it was under OZ 1.0. And also in OZ 1.0, with the poverty thresholds that they had in place to designate those Opportunity Zone tracts in the first place, they were using 2010 census data. I don't know what year's census data they're going to be using when they have the new round of designations that come out in July of next year. But I think that those are important things to kind of keep in mind is, hey, you might be able, number one, you have to get your gain into an OZ fund within that 180-day period for it to even remotely be qualified. So, maybe your timing just doesn't work out to wait until 2.0. And then notwithstanding that, even if you had that theoretical flexibility to wait, maybe the project that you're investing in, that you have the opportunity to invest in right now, is just going to be more attractive because it was a census tract that, yes, satisfied the poverty thresholds, but it was based on 2010 census data that got you there. So maybe it's just a better investment. So I think that that's kind of why it's it depends answer as to whether somebody should invest now or wait till later.
And there's a question just as it relates to 2.0. Has there been any changes to how like QOZs for operating businesses, how they operate, or separate from real estate, how that program works, or is it all effectively the same at this point?
Not really. So what we found, or at least I'll speak for myself, what I found in practice is the vast majority of opportunity zone deals that we're seeing are real estate related. Every now and then we do come across, somebody that wants to have more of an operating company fit within the rules. It's just the way that the rules were devised, and unfortunately they didn't change much of this in OZ 2.0, is that it's hard. Your operating company needs to really fit a specific fact pattern in order for it to be able to check all of the boxes to have all of the necessary quote unquote good assets in the opportunity zone business. And the way that you're running your business needs to fit within those parameters. And those really haven't changed from OZ 1.0 to 2.0.
Yeah, I agree with Matt. I think a lot of the guidance and a lot of what has been done has been real estate focused. It's really easy with real estate. You know where the property is located, right? I mean, it's attached to the ground. You know where the revenue is coming from, right? It's coming from the building itself. I think we've seen some operating businesses as well. We've seen some in the life sciences. We've seen some from like a management company type of perspective. The biggest issue there usually is like, where is the revenue being generated, right? You have the 50% gross income test. The IRS provided a couple of, ways to test that, whether it's, where your employees located, right? Where are they spending their hours? And that's either on an hourly basis or on on a payroll basis. But it becomes a lot more difficult when you have an operating business that's really operating in multiple jurisdictions, right? Because meeting those tests that Matt was referring to, it becomes a lot more difficult. It's not impossible. You really got to work through some of the math. You really got to set up like a tracking mechanism. We had a client that was actually tracking like the location of employees kind of clocking in and out to make sure they meet those tests. It's just that there's more kind of hoops to jump through, right, than with real estate.
Yeah. And I guess what was also interesting on that is, as Michael was referring to, is, to satisfy that gross income test for an operating company, a lot of it is tethered to where the services are being performed. And so, of course, these rules were devised before COVID happened and this explosion of remote work really took off. And so, perhaps that was a little surprising that there wasn't an update there. Maybe there will be when supplemented Treasury regulations are released, but that's, as of right now, nothing has really changed on that.
And then most of the projects that have been done under the OZ program to date, as you look just across the different property types, obviously we've been primarily focused on hotels ourselves. As you mentioned, Matt, us doing a lot of select service, limited service, in some cases, these lifestyle hotels and different OZ tracks. And, we've executed on over a dozen of those projects, but is it mostly multifamily or industrial properties, or what have you seen been the majority of the property types utilized for opportunity zones?
Yeah, I can go first. I guess the vast majority of the deals that I've worked on have been in the multifamily and the hospitality spaces. I have done some industrial opportunity zone deals. Those can just get a little bit hairier because, typically we're structuring these in what we call the two-tier structure, where you've got the OZ fund that sits on top of an OZ business that actually owns the property. And at the OZ business level, one of the requirements is it needs to be engaged in an active trader business. And the IRS has specifically said that triple net leases do not rise to the level of being an active trader business. And so that has presented some issues with accomplishing what the desired business plan is for an industrial development project. But we have worked with clients to kind of try to get the leases out of the triple net lease realm and things like that. But that's been my experience.
Yeah, similar to Matt, I've seen a lot of multifamily. I've seen some mixed use, some office development. What will be interesting with QOC 2.0 is with that new rural benefit, right? Because that is a nice kind of add-on benefit. Is that going to shift the type of, assets that are being kind of developed? Rural areas, data centers are really popular, right? There's a lot of buzz now about data centers, anything kind of focused around AI in general. So it'll be interesting to see, if, market participants are able to kind of utilize QOZs in conjunction with, the whole like AI trend with data centers and other development. Another interesting kind of concept is, part of the one big beautiful bill act that was enacted a couple months ago is this concept of like a qualified production kind of facility. So we did talk about a little bit before about depreciation recapture and the different benefits. So there is this new kind of code section that provides for an immediate complete write-off of certain types of properties, and it's really geared toward like manufacturing facilities, right? Kind of owner operator type properties where you're kind of building a piece of tangible property, think about like a factory. It'll be interesting to see if there's any way where those benefits are combined with the QZ benefit.
Clearly, the new administration has a lot of push on shoring and manufacturing back in the U.S. So I guess the OZ program could help capitalize some of those projects, as you mentioned, Michael. Just a lot of that's happening in these rural type markets. A lot of cases, the manufacturing is in smaller markets, so theoretically, this could be a liquidity source or a way for some of these manufacturers to find capital that are undercapitalized potentially. Am I wrong on that?
Agreed. If structured properly.
Yeah. Going back to operating businesses and thinking about the different property types, affordable housing is a big discussion, right? That's another, challenge in capitalizing, because a lot of cases, everyone wants to develop affordable housing is just trying to make financial sense given the cost of construction has risen so much, and the need to have certain return thresholds for investors. Could you could a track that sits in an opportunity zone, could you somehow set up a operating business where you did it like home development, like where you could create a home developer business and then, turn around and use that development company to fund the development company to go develop homes in different markets where maybe it's not an opportunity zone? Could that theoretically be a business?
So are you talking about like modular homes and things like that
That's
would
right.
all be built in this production facility that's housed in the opportunity zone, but then, the homes are sold elsewhere. Facts and circumstances dependent, of course, as always, but theoretically, yes, that could be set up to be a qualified opportunity zone business.
And there's another question. Someone's saying, is there any specific geographies across the U.S.? As you look at opportunity zones, obviously each state has the right to mandate which tracks they want within their state. So the governors of each state, if I'm not mistaken, are the ones choosing, or the governor's office. But then, has there been any data just on which parts of the country have had the utilization of the program more than other parts of the country, or has it been or there's just no data out there, or has it been evenly dispersed?
Well, I think that there is data out there that exists. It's just mostly self-reported data. So I've seen maps, and I can't remember off the top of my head which areas within the country have been the most ripe or most popular for OZ investments. But I do know that there are maps that, various companies or agencies have done and have released to kind of show you where predominantly these are the areas that are seeing the most OZ investment. But I think that that's also something that I didn't get to touch on with the change in OZ 2.0 is, like I said, a lot of that was a function of self-reporting from the OZ fund sponsors because they had a vested interest in trying to keep this program going beyond 2026. And so they wanted to show, the government, hey, this is a great thing. Look at all of the new development and all the new jobs and everything else that we're making available as a result of an opportunity zone investment. But in OZ 2.0, one of the new features that especially somebody like you, Greg, who's a OZ fund sponsor, need to be aware of is there are heightened reporting requirements. And the devil's going to be in the details as to what exactly that is. I guess from a high level view, there's just going to need to be more mandated reporting on some of the investments and what those investments are, where are they located, how many jobs did you create, things like that are now going to be required to be reported.
Yeah, and this has been talked about for several years already, is the reporting, right, to Congress or Treasury. Right, historically, there was reporting really being done by QFs, at the QF level, right, to the IRS. They've essentially enacted a whole nother set of reporting required at each QOZ business as well. And they added certain metrics like the number of residential units, employees, certain metrics like that. Really, again, because I think as part of the new act, the Congress is really looking for more reporting from the Treasury to see, how are taxpayers really utilizing, this benefit? Are these investments achieving the goals, right, that Congress had in enacting this law?
There's a question about any limits on claiming bonus depreciation in an opportunity zone project, assuming, and this is technical, I don't know what this means, but PIS date after 11 or
Sure.
1/1/2027, ABBA, OBBBA applies. So I'm assuming Matt and Michael, y'all know that. So I'll let y'all answer.
Yeah, I mean, I can take a shot first, Michael, and then you can fill in the blanks. But so one of the features of the one big beautiful bill is bonus depreciation is back. 100% bonus depreciation is back. And so I guess the short answer is yes. If you are investing in a project that's kicking off bonus depreciation, that you can take advantage of that. However, what's important to recognize is that if you're making an opportunity zone fund investment, you're investing pre-tax dollars. And the way that the rules work, so back to my example where I put $1 million of capital gain into an OZ fund, I don't have any tax basis in my OZ fund interest at the time I make that $1 million investment. And so the way that, all the various partnership tax rules work when you're talking about tax losses getting kicked out through a partnership is I need sufficient tax basis in my interest in the fund to be able to utilize those losses that are coming from the bonus depreciation. And there's various ways to get tax basis, but I think that kind of gets lost in the shuffle a lot of times as people just say, oh, well, not only to get the OZ benefits, but I also get all of these huge losses allocated to me from the new bonus depreciation rules, which technically is true, but there's a lot more to the analysis to make sure that you can readily use those losses, currently rather than having them be carried forward until you have sufficient tax basis.
Yeah, I agree with Matt. I think that the basis consideration is valid, right? The money you're putting into these deals does not have basis, right? You haven't paid a tax on those dollars, so you can't have basis yet. In a lot of these projects, there is debt financing. If it's non-recourse, I mean, there's issues if there's guarantees and if it's really recourse. But traditionally, if you have traditional debt on a property and it's non-recourse financing, that does give you basis to take losses, including the bonus. But again, you really have to kind of understand the entire project. A couple other key things to think about in that regard. Again, states don't always conform to bonus depreciation. Again, I always bring up the states. 100% bonus is great. But if you have passive investors, I'm located in New York. New York's a great example. If I invest into a real estate project, I'm an accountant. I don't get any benefit of those losses, right? If I have no other passive activities. In New York, I'm going to have to add back that bonus depreciation and pay basically phantom tax on that loss that I got no benefit of. So really important to think about who are your investors, right? When you're doing these cost seg studies, right? We have a team, we get involved in a lot of projects. We have a separate team, I mentioned valuation appraisals, cost segregation studies. A lot of you have probably heard of. When you buy a project, you develop a new project. Instead of depreciating everything over, 27 and a half or 39 years, you can go in and break apart those assets into bonus eligible, which is great, right? You could really kind of identify a lot of bonus depreciation. Again, do the cost seg studies, but first think about who your investors are. Are they getting the benefit, or are you going to create some kind of phantom tax for them? Really important to look at.
Yeah, I highly recommend, just because, again, we're developers, we're investors. We have a private equity firm that, invests both on the, the credit side as well as the equity side into opportunity zones. If you have questions, I highly recommend reach out to Michael on that, because I can tell you right now, we do a lot of business with Safearth and Matt specifically, just as we're trying to structure our opportunity zone investments, because there's a lot of nuances. And there's no question, Eisner Amper and Michael's firm is incredible as well. And we've utilized them in the past as well. One person's asking a question about how they own some industrial and office properties already located in Opportunity Zone 1.0. How can they leverage their properties being in these OZs to partner with someone to help come in and develop real estate projects or take advantage of these laws? I'm assuming it's industrial and office, and some of these properties may be impaired at some level because you think of office, you think about the secular distress. I could be totally wrong on that, and I apologize if I'm wrongfully making that assumption. But either way, how could someone invest into existing assets that sit there? I mean, Mike, I guess Michael or Matt, do you want to talk through that, how that works, or how someone could do that?
Yeah, there's different ways. This question has come up since 2018, 2019 when this first came out, right? And I think the question is, somebody already owns a piece of property that's in a QOZ. How can they benefit from this, right? One of the general rules is you really need to buy new property, right, after the designation date effectively to make it work so that you can kind of get your capital gains in there. There's different ways for existing owners to benefit as well. And, we've been analyzing from many clients, how do they benefit? And maybe not from a QOZ perspective, but from a fundraising perspective, right? There's ways to potentially lease the property into a QOZ business, right? That you're kind of fundraising. And you may be able to invest some money in there as well from capital gains. There's ways to potentially just contribute the property into a joint venture. Again, that is not a good QF investment, right? If you put property into a QZ business, your equity is not getting the QZ benefits, but you are now attracting other capital, right, from QZ investors. So there's definitely ways to still participate in the program, maybe directly or indirectly, but it's kind of weighing all those different strategies. The simplest is maybe selling it. If it's in a QZ zone, maybe there's some kind of premium in the market for somebody that's looking to do a QZ deal. Again, so there's ways to kind of still benefit from it, but again, multiple options, and 3 minutes is unfortunately not enough time for me to go through all of those.
That's one where I think the short answer is there's a lot of different alternatives, but that requires a much longer conversation to understand all the facts and circumstances.
And then to close it out, because I know we're coming to the end, I think this question is probably just looking at who's attending this webinar. I'm sure this question is relevant to most of the attendees. Do the new rules address carried interest treatment to fund managers of qualified opportunity zones or qualified opportunity funds? Is there any way to help shelter your carried interest in some creative way? I'm assuming there's nothing that's unique there. I'll let y'all answer that question just because.
There was nothing. So let me start here. There was nothing in OZ 2.0 that changed the general rule that carried interest from a qualified opportunity fund does not get the 10-year tax-free benefit, right? But even under OZ 1.0, I have seen certain structures where the carried interest is not necessarily taken at the OZ fund level, but perhaps at the OZ business level. But there are a lot of risks and potential rewards for trying to structure something like that. And so that also kind of falls into the category of probably deserves a more fulsome discussion outside of the 2 minutes we have left.
Yep. So with that, I'm going to go ahead and turn it back over to Alana. I just want to say thank you to everybody that's listening to us. And if you ever have questions, I'm always happy to, answer any questions that I can as it relates to opportunity zones. If you're looking to, invest into opportunity zones, or if you have projects, we're always looking to, we've done a bunch of JVs on the development side as well. So we're always looking for opportunities on that front, as well as providing debt financing. There's no question Matt and Michael are, again, they're experts on opportunity zones and highly recommend utilizing one or both of them if you have a project. And with that, I'll turn over to Matt and Michael if you have any final comments, and let Alana take over from there.
Yeah, no, I think it's by and large, it's an exciting time for opportunity zone investing. I'm starting to have flashbacks from 2018, 2019, where it's just on the OZ talking circuit. It's what it felt like. And I think Michael's in the same boat there. But yeah, like Greg said, same for me. I think everybody has my email address. Just shoot me an email and we can set up a call to talk.
Yep. Kind of to echo Greg and Matt, thanks to everybody for participating. Feel free to reach out to myself or any of us with more questions. We're happy to help. There'll be more guidance coming in hopefully the next several months and years on some of these uncertainties as well.
With that, Alana, I'm going to turn it back to you and just say thank you to the BizNow team for putting this on. I think it's a great content, great way to help educate the commercial real estate community on what's happening with Opportunity Zone. So thank you.
Absolutely. Thank you, Matt, Michael, Greg. We really appreciate you all for having this super insightful conversation. I know I learned a lot, so I know our attendees have as well. Want to thank again our sponsors, our amazing panelists, and all of you for attending and watching. If you missed any part of this panel, don't worry, it'll be sent to you after the event concludes, and then it'll also be on the event page for you to come back and watch at a later time. But with that, thank you all so much. I hope you have a wonderful rest of your day and have a good one.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.